Investing can feel overwhelming, especially when you're bombarded with stock picks and market predictions. But what if you could build a portfolio that grows passively while paying you regular income? Today I'm going to show you how to create a lazy dividend portfolio using ETFs, so you can get paid while barely lifting a finger. Let's dive in. Welcome to the channel. I'm the Swedish dividend investor, and today we're going to take a look on how to set up a lazy dividend portfolio using ETFs. This is not financial advice. I'm just a guy on YouTube who wants to help people think differently about investing. Make sure to read the full disclaimer in the description down below. ETFs or exchange traded funds are a great way to get started with investing. The fund consists of a basket of stocks, and they can have a certain focus. For example, there are ETFs that tracks indexes, like the S&P 500 index, the 500 largest publicly traded companies in the US. And there are ETFs that focus on precious metals, certain sectors, countries, and also dividends. You probably have heard about dividend investing, but maybe you don't know how to get started. Maybe you only want to focus on dividend growth, or maybe you're near retirement, so you want a higher yield, or something in between maybe. We can take a look at a few examples. Personally, I like a decent yield and some growth. In my opinion, putting all your eggs in a basket with a low yield and a high growth strategy and hoping for that growth to continue in perpetuity is sometimes just wishful thinking. There are a lot of things that needs to be in place for that to happen. So I'm going to share how I would think if I would get started with investing in dividend ETFs. So for this example, we're going to use 4 ETFs. We are doing different examples for different age categories or life situations. The first one is SPYW. We can see their stats here. Around 3.4% yield and a 6.35% compounded annual growth rate for the last 5 years. Their annual gain in share price for the last 3 years is almost at 6%. Very nice. The second ETF we will use is FEUI, 3.2% dividend yield, around 9.5% CAGR for the dividend and about 6% for the annual return. Just based on those numbers, we are looking at a 10% year return, if they can keep it up. Very nice. You will double your money every 7 years with a 10% return, so that is very good. The third one is for some high dividend. I've gone with JEPG for some stability and appreciation, and Global X Nasdaq 100 covered calls ETF for a higher income and a reduced upside. Covered call ETFs sells options, covered calls. A covered call is an option strategy where an investor who owns a stock sells a call option on that stock to generate additional income. If the stock price stays below the option strike price, the investor keeps both the stock and the premium received for selling the call. However, if the stock price rises above the strike price, the investor could be forced to sell their shares at that price, potentially limiting further gains. So the upside is limited and the downside gets cushioned somewhat from the premiums received from the options. Since they still hold the underlying equity, the price will fall, so you're not really protected. And after a fall, when the market starts to turn around quickly, covered call ETFs may gain slower. JEPG has a dividend yield of around 6 to 7%, and they only been around for little over a year, so we don't know the growth. I think a standard year they could gain about 3 to 4% in share price. QYLD has a very nice dividend yield of over 10%, and they actually grew their dividend by 11% for 1 year. The option premiums gets higher when the volatility increases, and the underlying index Nasdaq 100 had a great run last year, so that could be something to keep in mind. Of course, these are just projections based on historical data. Markets don't move in a straight line. Dividends can be cut and some years will be better than others. But over time, compounding and consistency makes a huge difference. Now, let's see how this all comes together in a real portfolio example. Let's go to our first example portfolio. Age category 18 to 30. Now, it's impossible for me to know your situation, so I've just gone with some number that feels reasonable. Let's say your grandma gave you 2,000 euros for your 18th birthday. Or maybe you worked on the summers during your school years. You get the point. You just got your first job and you want to save some money. I went with 100 euros per month here. Now, since you have a bit of time until you can retire, you don't really need the high cash flow and high yield investments right now to pay your bills or take vacations. So what I would do is to put 70% into dividend growth, giving you a small cash flow you can use to reinvest and some decent growth of that dividend. I've gone with 50-50 between SPYW and FEUI. Then we have JEPG and QYLD. Here I would put 30% of my capital for some higher current yield. I believe dividends are key to investing in the long term. Seeing the dividend grow month over month when adding new capital and reinvesting the dividends is very motivating and powerful. And the day you retire, you don't have to sell your shares to pay for your lifestyle. Even when the market is down, when you have invested in reliable dividend companies and ETFs, you will still get that cash flow. And when buying during down periods, you will get even higher yields. Anyway, the first 2,000 euros I would lump sum invest between the 4 ETFs. That's 700 euros each for the dividend growth ETFs and 300 euros each for the high yield ETFs. The monthly savings equates to 35 euros for SPYW and FEUI. As we can see, that will give you roughly 1.3 shares per month in SPYW and 5.4 shares in FEUI. If you have a good broker, you can buy fractional shares, meaning you can buy 1 plus 0.3 shares in the case for SPYW. No broker with a Swedish tax advantage account offers fractional shares. So if you're in the same situation, just save that money for next month. The dividend will help to boost the share count as well. I have some metrics here. I will only go over this for this example, and I use it in the other examples as well. We have mixed yield for each of the 2 ETFs in both of the portfolios. Same with the growth and performance. I use these numbers for calculating the future value. Using the portfolio growth and yields, we can simply head on over to a dividend reinvestment calculator and punch everything in. We do one portfolio at a time. So for the inputs, I've used 1,400 euros starting principal, yearly contributions 820 euros, distribution frequency quarterly. I went with 0 dividend tax. You can always play around with this calculator and see how your taxes impact your investments. Annual yield 3.32%, growth 7.8%. This is the mixed growth. 5% share price gain per year and 20 years invested. Take a look at that. Your dividend growth portfolio has grown to 54.8k, spitting out over 3,000 euros per year in income. Your yield on cost, since the dividend has grown, is over 15%. Now that's juicy. The yield on cost is the yield on the amount you have paid, but when the dividend keeps growing, so does the yield. Now for the high growth. Monthly distributions, 600 euros starting out, 360 euros per year, 8.7% yield, dividend growth of 2% and 3% annual share price gain. After 20 years, this portfolio is worth 28.2k, spitting out 2,000 euros in dividends each year and has a staggering yield of cost of over 25%. Summing it up, portfolio value of 83k, yearly income of 5.2k, and current portfolio yield of 6.3. The current yield is the dividend divided by the value of the portfolio. Maybe you'll say,
"But Swedish dividend investor, that's not much after 20 years. I can't live off that."
and you're right. In my opinion, you should aim to increase your savings every year. Since when you're a bit more established, you can make a better living as you grow older. And when you invest, you also get more comfortable with doing it and getting even more motivated to save even more money. I tried looking for a dividend reinvestment calculator with increased savings, and this is the only one I found. I can show you what would happen if you were to increase your savings by 20% annually. Now, I know 20% sounds aggressive, but remember, this is not about saving more forever. It's about ramping up as your income grows, then leveling it off when you're comfortable. At the final year, your yearly savings would amount to just under 9,000 euros. That's about 750 euros per month. With inflation for 11 years, I would say it's not only probable, but it's possible. As an example, I'm 36 and I save over 1100 euros per month currently. We can see what a difference the savings does. You will get to around the same numbers in 12 years time. So starting off when you're 18 until your early 30s. Then the compounding really starts to kick in. Now with this calculator, I can't lower the savings rate after 30. And saving 20% more beyond that every year starts to get ridiculous after 12 years. If we continue the savings increases until you're 40, you would invest over 32k per year or 2,666 euros per month. And that might be a stretch. Now, putting these numbers in a calculator gets complicated. If we could use them in the first calculator, the yield on cost gets lost and we start over with a 3.32% yield, messing things up. And we can't just use the yield on cost, since that makes things go bonkers. I just want to show you what is possible without complicating things too much. By the way, if you're watching this, what's your dividend strategy? Are you focused on growth, yield, or a mix? Drop a comment and let's compare. Now, moving over to if you're 30 to 50 years old. If you didn't invest in dividend stocks in your 20s, or maybe you bought an apartment, lived in it for a couple of years before selling it, saved in regular index funds, or just bought some broad-based index ETF, I'm assuming you're a bit more established. You have 10k in savings and can save roughly 800 euros per month. These numbers are just for example. You may have more or less of this. Here I would shift into 50-50 allocation between growth and income. Maybe you did well in your 20s and would want to live off the dividends sooner than later. I will link to the calculators I use down in the description so you can play around with the numbers that fits your situation. Remember, this is lazy dividends. So we can see the savings for each month. And just like last time, we enter the same dividend yields and the same growth numbers. The only difference is the amount of money and allocation. We can see after 20 years that the growth portfolio has grown to almost 300k and is paying you 17k per year in dividends, with a yield of cost of over 15%. Very nice. Note the average annual return. You don't have to 10x or beat the market just to get rich. Just compound slowly and safely over time. As always, the more aggressive growth numbers we use, the more it affects the calculation. We went with conservative growth for the share prices. The high yield portfolio has grown to over 350k and is paying almost 26k in dividends per year and has a whopping 24.35% yield on cost. Adding these up, we're looking at a portfolio value of 646k, a yearly dividend of 42.9k, and a portfolio yield of 6.64. Now that's some money. I do think it's realistic to save up to this from 18 years old. Grind hard, be frugal, and don't waste your money. If you increase your earnings potential and savings rate and invest over 20 years, heck, even 10 years, it could be life-changing. Maybe you can't live off the dividends, but your financial position is going to get better. Unplanned expenses is no worry for someone who is frugal and has a strong passive income. You will sleep better at night knowing you're earning dividends in your sleep, and those dividends will get to work and earn you even more. Sorry for my ranting. Anyway, moving on to the age category of 50 plus. Now you are very established. Maybe you have your own small business or sold your house and moving into a rental property. Again, this could be your situation in your 30s or late 20s, who knows? You get the point. By now you have 100k in capital and could easily save 1400 euros per month. Now, I would focus on getting that passive income as high as possible, but still wanting some growth, since we do have to keep inflation in mind. So we are going with 30% into growth and 70% into high yield. To be honest, if you're starting to reach a level of income you could easily live off, I would shift to maybe 20% growth and 80% high yield, maybe even 15/85. As before, we can see the monthly savings. The starting total portfolio yield sitting at 7.1%. Here is when stuff gets bonkers. I've always heard, after your first 100k invested, the compounding snowball really kicks in, and we can see that here. The growth portfolio has almost reached 460k and is paying 26.3k in dividends per year with a yield of cost of 18.24%. The high yield portfolio has reached a staggering 1.34 million in value, and the dividends per year is close to 100,000 euros. The yield on cost is over 30%. Looking at the summary, we can see the total value is 1,805,231 euros, and the dividends per year is 125,928 euros. That's impressive. However, this is just me coming up with numbers, but I think we used pretty conservative numbers. But we know stuff doesn't work like this. Sometimes the market will be overvalued, giving us a lower yield with each buy. Sometimes it's undervalued and will offer a higher yield. Dividends can be cut and they can also grow faster. I think you get the point. I just wanted to show you how you can think when setting up a 4 ETF Lazy Dividend Portfolio and playing around with numbers. One thing I would like to add is that I don't really like investing only in ETFs. Sure, they are a great way to automate things, but they remove your thinking. I want you to think about what you own, the risks, and what value it offers to you. Just something to keep in mind. So what did you think about this thought experiment? What's your strategy? Do you also hold any of these ETFs, or maybe you've gone with a similar strategy? Let me know in the comment section down below. With that said, I hope you enjoyed the video. Leave a like if you did, and consider supporting me by subscribing. It helps me a lot. I'm the Swedish Dividend Investor, and I will see you in the next one. Ha det gött!